Listen, gold just did what it always does before silver goes vertical. It moved first, calm, confident, relentless, grinding higher day after day, making new all-time highs, breaking through resistance levels like they don't even exist. Gold is acting like a strategic asset, like a reserve currency replacement, like the anchor of the monetary system. And that behavior matters, because gold's behavior tells you what's coming next for silver. Silver didn't follow politely. It didn't rise in lockstep with gold. Silver hesitated, twitched, coiled. It's lagging, it's frustrated, it's compressed. And that reaction, that specific pattern of gold leading while silver compresses, matters more than most people realize, because it's the exact setup that precedes silver's most violent moves. Silver doesn't move like gold. It doesn't trend smoothly. Silver doesn't rise gradually over months and years in a nice orderly fashion. Silver snaps. Silver explodes. Silver teleports. And when it moves, when that coil finally releases, the speed shocks everyone, even the people who were expecting it, even the people who have been bullish for years. Because the human brain is not wired to process exponential moves. We're wired for linear thinking. We assume tomorrow will look like today. We assume price changes happen gradually. But silver doesn't obey that assumption. Silver is chaos. Silver is leverage. Silver is the market, as a way of punishing consensus and rewarding those who positioned before the crowd realized what was happening. Today, I want to walk you through a scenario that sounds extreme to most people, a scenario that will make skeptics laugh, a scenario that sounds like hope from silverbugs who have been wrong for years. But it's actually very simple when you understand market structure, when you understand flow, positioning, and how small the tradable silver market really is. A scenario where silver can reach $100, not in months, not in years, but in days. This week, by Friday, before the weekend, before you have time to adjust. This isn't because of hype or Twitter predictions. It's because of flow, leverage, timing, and a shrinking exit door. It's because of market mechanics that force price adjustment faster than participants can react. This is not a promise. I'm not giving you a guaranteed outcome. This is a map. This is a framework. This is showing you the path that exists, the mechanism that could execute, the sequence that could unfold if certain conditions persist. And those conditions are already in place right now. So let me show you how this works. Let me show you why $100 silver isn't as far away as the chart suggests. And let me show you why speed matters more than distance. A quick disclaimer, this is not financial advice. This is for educational and market analysis purposes only. Always do your own research and consult with professionals. Never risk money you can't afford to lose. Now let's break down the mechanics of how silver reaches $100 and why it happens faster than anyone expects. The biggest lie people believe about silver is that it moves slowly. They assume silver is just volatile gold, that it trends like gold but with bigger swings. That's completely wrong. Silver is not gold's little brother. It's an entirely different animal. Gold is a battleship, massive, slow, powerful. It takes time to change direction. Gold trends, gold grinds, gold moves in months and years. Silver is a speedboat with nitrous, light, fast, and unstable. It sits still for long periods looking dead, and then it explodes in a burst of acceleration that leaves everyone behind. When gold trends, silver doesn't gradually follow. It waits, it compresses, it frustrates. It makes everyone doubt whether it will move at all. And then it teleports, it gaps, it skips price levels. It goes from $74 to $85 to $95 without stopping in between. Why does silver behave this way? Why is it so different from gold? Because silver's tradable market is tiny, microscopic compared to other asset classes. The entire investable silver market, all the silver that's actually available to trade, all the bars, coins, and ETF inventory, is worth maybe $50 billion. Maybe. There are single tech stocks whose market cap is larger than the entire investable silver market. Apple is worth $3 trillion. That's 60 times the size of investable silver. Microsoft, Amazon, Nvidia, any one of them dwarfs silver. So when people say silver is going to the moon, they don't understand that silver doesn't need the world to buy it. It doesn't need mass adoption. It doesn't need everyone to pile in. It just needs a few large hands to move slightly faster. It needs one sovereign wealth fund to decide they want physical. It needs one industrial buyer to panic about supply. It needs one family office to allocate 2% to silver. That's it. That tiny amount of capital moving into a tiny market creates massive price displacement. And right now, those hands are already moving. The flow is already happening. The accumulation is already underway. Most people just haven't noticed yet. Before we go further, let's talk about why $100 matters. Because 100 isn't just a number. It's not just another price level. It's a story trigger. It's a psychological threshold. It's the moment when silver stops being a niche investment and becomes a mainstream headline. Markets don't react to math or supply-demand fundamentals in real time. They react to narratives. They react to stories. And $100 silver is a narrative that travels faster than facts. It's the kind of headline that spreads, that gets shared, that makes people who don't follow silver suddenly pay attention. Once silver prints numbers in the 90s, once it breaks through 95 and starts approaching 3 digits, everything changes. Headlines change from silver rises to silver nears historic milestone. YouTube thumbnails go from technical analysis to silver explosion. The tone on social media changes from skeptical to euphoric, and most importantly, behavior changes. People stop asking, should I buy silver? That's the question they ask at $74. At $98, at $99, they ask, am I too late? That's fear of missing out. That's FOMO. That's the psychological switch from evaluation to panic. And that's when liquidity vanishes. Because everyone who was thinking about buying decides to buy at the same time. Everyone who was waiting for a pullback gives up and chases. Everyone who was skeptical suddenly believes. And when liquidity vanishes in silver, when everyone is trying to buy and nobody is selling, price doesn't walk higher. It jumps, it gaps, it teleports through levels. This is why $100 matters so much. Not because it's technically significant, but because it's psychologically significant. It's the trigger that converts skeptics into buyers. And in a tiny market like silver, that conversion creates violence. Now let's strip emotion out and talk pure mechanics. Let's talk about what's actually happening in market structure right now. Here's what we're seeing. Number one, gold is being bid strategically. Gold is not being traded or flipped by hedge funds. It's being accumulated. This isn't retail momentum or speculative buying. This is sovereign behavior. Institutional balance sheet allocation, central banks, family offices, entities that measure time in decades, not days. Gold is acting like a reserve asset, not a trade. It's acting like something you own as permanent wealth. And when gold behaves this way, grinding higher with consistent buying and no major pullbacks, it tells you the smart money is positioning for monetary instability, for currency debasement, for the kind of environment where paper promises lose value and physical assets gain. Number two, silver is the leverage expression of that bid. Silver doesn't need its own story or catalyst. It borrows gold's engine. When gold is accumulated, because of monetary concerns, silver piggybacks on that narrative, but with more violence, more speed, and more volatility. Because silver is smaller, because it's more volatile, and because silver has industrial demand layered on top of monetary demand. So when gold moves for monetary reasons, silver moves for monetary, industrial, and speculation reasons. It's triple leverage, and that triple leverage is what creates the explosive moves. Gold might rise 20%, silver rises 80%, gold might make a new high, silver makes a new high, and then overshoots by another 30%. This is the mechanism. This is why silver's lag right now, its compression while gold rises, is actually bullish. The more silver lags, the more tension builds, the more the spring compresses, and the more violent the release when it finally comes. Number three, free float matters more than total supply. This is critical to understand. People look at the total above ground silver supply and say, there's plenty of silver. They point to the billions of ounces that exist, but that's irrelevant. We need to talk about the free float, which is the amount of silver actually available for sale at current prices. This is the silver held in vaults, in ETFs, the bullion sitting on dealer shelves. That's the real market, and that market is paper thin. Most silver is not for sale. It's locked away in industrial products, in jewelry and silverware passed down through generations. It's held by long-term investors who wouldn't sell for a 10 or 20% gain. It's considered permanent wealth, insurance against chaos. So when new buyers come into the market, they're not competing for billions of ounces. They're competing for the very small fraction of silver that's actually for sale. This is why a small increase in demand can cause a massive price spike. The supply side is incredibly inelastic. Nobody's melting down their family heirlooms because the price went up a few dollars. It takes a huge price change to bring that dormant supply to market. And right now, that available supply, that free float, is shrinking. Dealer inventories are low. Mints are reporting delays. ETF stockpiles are being drawn down. Meanwhile, demand is steady and growing from both industrial and investment sources. So you have growing demand chasing shrinking available supply. That is the recipe for a price explosion. The market is getting tighter every single day, and the pressure is building. When that pressure releases, it won't be a gradual price rise. It will be a supply shock that reprices silver almost overnight. So let's put it all together. Gold is leading, signaling a major monetary shift. Silver is lagging, compressing energy like a coiled spring. The tradable market for silver is microscopic and getting tighter by the day. And the psychological trigger of $100 is getting closer, ready to unleash a wave of FOMO buying. This is the perfect storm. This is the setup for a teleportation event, Again, this is not a prediction, but an analysis of the existing market structure. The pieces are all on the board. The sequence is clear. The question is not if, but when the final domino falls. Keep your eyes on the gold-silver ratio, on dealer inventory levels, and on the flow of capital. The signs are there for those who know where to look. The speed of the move could surprise everyone. When we talk about silver, most people think about total supply. But that's not what matters. What truly matters is the tradable, deliverable, available supply. Sure, silver is everywhere, in jewelry, old coins, industrial scrap, even landfills, but you can't just snap your fingers and turn your grandma's necklace into a 1,000-ounce industrial bar. Collecting and refining all that silver takes time, money, and a high enough price to make it worthwhile. Mines can't just flip a switch and produce more overnight. It takes years to ramp up production. Refineries are already running at full tilt, and with China controlling a huge chunk of refining and restricting exports, there's a serious bottleneck. But here's the catch. Demand can spike instantly. An industrial buyer needs to secure 6 months of inventory. They buy it all today. A hedge fund decides to allocate to silver. They buy today. Retail investors get a case of FOMO. They buy today. This mismatch, this huge gap between instant demand and slow, sticky supply, is where price explosions are born. When elastic demand slams into inelastic supply, the only thing that can give is the price. And it has to rise far enough, fast enough, to either destroy that demand or somehow magically stimulate new supply. Given that industrial demand is pretty fixed and supply takes ages to respond, the price has to go up a lot, and it has to happen fast. Now, let's talk about timing. Why now? Why not 6 months from now? Because silver doesn't move in a slow, predictable way. It breaks when pressure builds up for a long time, like a coiled spring. And right now, what do we see? Gold is hitting new all-time highs, day after day, week after week. That's serious, strategic buying. Silver is lagging, but it's not breaking down. It's holding its ground, building a base, getting more and more compressed. The daily price swings are getting smaller. That's the tension building. At the same time, nobody's talking about silver. The financial news isn't covering it. Your friends aren't asking you about it. This is the stealth phase when the smart money is quietly accumulating. Most traders are still skeptical. Some are even betting against it. That skepticism is the fuel for the fire. When you combine all these factors, strong gold, compressed silver, low volatility, and low attention, you get a perfectly coiled spring, ready to explode. Once silver clears its last major hurdles, say around $80 or $85, the market won't have time to think. It reprices before anyone can agree on whether it's justified. That's how silver has always moved. Not gradually, but in explosive bursts that happen so fast, by the time you realize what's happening, the move is already over. So let's walk through the exact sequence of events that could take silver to $100. It's not a slow climb, it's an overshoot. Step 1, gold keeps pushing higher, driven by institutional and central bank buying. Step 2, silver finally catches fire. After weeks of frustration, it breaks through resistance and starts making new highs. Suddenly, it's up 3% one day, 5% the next. Momentum is building. Step 3, the short sellers panic. The traders who bet against silver realize they're on the wrong side of the trade and rush to buy back their positions to cut their losses. This buying frenzy just pushes the price even higher, creating a vicious cycle. Step 4, liquidity dries up. As the price soars, sellers disappear. Why sell at $82 if it might hit $90 tomorrow? They hold back, waiting to see how high it can go. But buyers are desperate. This creates a situation where prices can jump dramatically on very little volume. Step 5, the algorithms kick in. Automated trading systems that follow trends see the upward momentum and start buying mechanically, adding even more fuel to the fire. Step 6, the headlines ignite. Silver nears $100. The mainstream media and social media go wild. This attention creates even more buying behavior. Step 7, the retail crowd arrives late. The average person, driven by FOMO, finally jumps in. They're buying at $95, $98, $99. They're buying at the top, providing an exit for the smart money that got in early. At this point, $100 isn't a ceiling, it's a magnet. Once it breaks that triple-digit barrier, momentum can carry it even higher, to 105 or 110, not because of fundamentals, but because expectations have completely reset. This is how parabolic moves work. They overshoot rational levels. But here's the part most people miss. The real risk isn't just getting to $100, it's what happens after. Silver tops are not clean, orderly events. They are chaotic and designed to trap as many people as possible. Here's the classic pattern. A violent spike up, say, from $85 to $102 in a few days. Everyone is euphoric. Then, a fake pullback to maybe 94. The bulls call it a healthy dip. Then, another rip-roaring spike to a new high, like 115. This is when the smart money, the institutions that bought way back at $60 or $70, start selling their positions to the frantic retail buyers. Once they've sold, the price collapses. It falls just as fast, or even faster, than it rose. Panic selling is always more intense than panic buying. This is why having rules is more important than having a price target. To navigate a potential move to $100 silver and beyond, you need the right mindset. This isn't about blind faith or being a permanent bull. It's about flexible, adaptive, rule-based discipline that captures the upside while managing the downside. So let's be absolutely clear. $100 silver isn't a fantasy. It's not just wishful thinking from people who have been wrong for years. It's a conditional outcome. It happens if gold continues to act like a strategic asset and silver's market structure snaps, if the coil releases, if the spring extends, if the mechanism we've discussed executes. Now, if this happens, and I'm not saying it definitely will, but if it does, it won't feel rational. It won't feel justified by fundamentals in that moment. It won't feel comfortable at all. It will feel extreme. It will feel like mania, like a bubble. And you'll start to doubt yourself. You'll think, this can't be real, this has to reverse. But in that moment, if it's happening, if silver is at $95 and climbing, your job is not to question it. Your job is to manage it. Take profit. Reduce risk, lock in your gains. Don't fight it, don't try to short it. Don't try to be a hero calling the exact top. Just manage your position and follow your rules. Remember that markets can remain irrational longer than you can remain solvent. The biggest danger isn't missing the move to $100. A lot of people will miss it. They'll doubt it. They'll wait for a confirmation that never comes. They'll wait for a pullback that never arrives. And they'll watch from the sidelines. That's painful. It's frustrating, but it's not fatal. You can survive missing a move. What you cannot survive is catching the move perfectly, riding it to 115, getting euphoric, believing it's going to 200, refusing to take any profit, and then riding it all the way back down to 60. That destroys capital. That destroys your psychology. That turns a winning trade into a devastating loss. So the biggest danger isn't missing it. The biggest danger is catching it and then believing it can't reverse. Believing that up is the only direction. Believing the rules no longer apply to you. That's what kills traders. That's what destroys accounts. That's the mistake that turns the opportunity of a lifetime into a total disaster. Here's my question for you. If silver hits $100, what do you think the market is pricing in? Is it pricing fear? Is it pricing the end of the dollar, the collapse of confidence in fiat currency? Is it pricing pure momentum, just technical acceleration, with algorithms chasing price without regard for fundamentals? Or is it pricing a structural repricing that doesn't care what any of us believe? A recognition that silver is genuinely scarce, demand is genuinely inelastic, and the previous price was simply wrong? Drop your answer in the comments below, because this matters. Understanding what drives the move determines how you should trade the move. If it's fear-driven, it's more sustained, but also more violent. If it's momentum-driven, it's faster, but more fragile. If it's a structural repricing, it's more justified, but also more likely to overshoot its target. Subscribe and turn on notifications, because if this unfolds, if silver makes that run to 100, we will be covering it in real time. Every day, every move, every single signal, we will tell you when to consider taking profit, when to reduce your exposure, when the market behavior starts to change. Because this is not about being permanent bulls. This is not about holding forever and believing silver is going to $1,000 an ounce. This is about recognizing an opportunity, capitalizing on it, and exiting before the rest of the crowd realizes the party is over. The fast horse is already twitching. You can see it in the price action. You can see it in the way silver compresses while gold extends. You can see it in the market positioning. You can see it in the flow of money. And when it bolts, when that coil finally releases, when silver goes from 74 to 85 to 95 in a matter of days, most people won't realize what happened until the price is already gone. They'll watch it happen. They'll doubt it while it's happening, and they'll finally believe it right when it's time to sell. Don't be most people. Understand the mechanism, understand the setup, understand that in these moves, speed matters more than distance. Understand that silver doesn't walk to its price targets, it teleports. And understand that the opportunity and the risk are two sides of the same coin. The same mechanics that drive explosive upside create catastrophic downside. The same leverage that can make you rich can make you poor. The same momentum that carries you to 100 can carry you right back down to 70. So have rules, have discipline, have a plan, and execute that plan regardless of your emotions, regardless of euphoria, regardless of fear, because that's how you win, not by predicting perfectly, but by managing imperfectly. The move is coming. The question is whether you're prepared for the speed. Thank you for watching. I'll see you in the next video where we break down exactly what signals tell you the top is in and it's time to exit. Because getting in is easy, getting out is where fortunes are made or lost.